Welcome back to another video. So in this video, I want to talk about a very important lesson if you are a beginner or an intermediate trader who is just starting out or enter a lot of positions, and that is risk management. Risk management is a very important topic in trading, whether you are trading stocks or crypto or anything for that matter. You need to risk manage your positions. So I'm gonna be throwing some numbers at you in this video. I'm gonna be throwing some formulas, equations. Small math jabs, no uppercuts, small jabs. And I'll be talking about my mistakes when I first started. And without further ado, let's go ahead and start. So risk management, what you should do before you enter a position. First thing is account risk. You want to limit your positions based on an account risk percentage. An account risk is how much you are willing to lose if the trade goes against you. Let's say you risk 1% of a 100% account. That equals to 100 trades. If you risk only 1% of your balance, you can stay in the game for 100 trades. If you risk 2% of 100% balance, you can do up to 50 trades. Someone might ask me, hey, 1% of 1,000 is $10. What the hell am I going to do with $10? I want to point out that account risk is not your buying size. It's how much you are going to lose if your stop loss is triggered. I'll talk more about that point in the next slides, but I just want you to understand that account risk is the amount that you're going to lose when your stop loss is triggered. By risking only 1 to 3%, your chances to stay longer in the game is drastically improved. So you can make small losses, make big losses, make small wins, make big wins for 50 positions if you risk 2% of your balance. You could even see here that if you risk 10% of 100% balance, that equals to 10 trades only. 10 trades before you blow up your account. And we all know that the market is not about making big profit in every single position. You could make 2 big profits, but more losses than wins, versus making small wins in a consistent way over time. So it's all about account risk, 1 to 3%. Even professional traders risk only 1 to 3%, and they are professional traders. And there's a reason why they risk only 1 to 3%. And my mistake that I used to do, I used to risk more than 10%, and I was even doing leverage trading. So kind of like learned my lesson over time that I should only risk 1 to 3%. The only time I could risk more than 3% is if I'm 99% sure of my plan. 99% sure of my plan. That's the only time I'm going to risk maybe a little bit over 3%. Other than that, I usually stick between 1 and 3%. So again, account risk is not the same thing as your buying size. Your buying position or your buying size is determined by your account risk, your stop loss, and your entry price. And I have more examples of this in the next few slides. The second way to risk manage your positions is by using a stop loss. We all know about traders, maybe new traders, that enter positions based on signals or friends or news without using a stop loss. And what ends up happening is the market will reverse against their plan. It will fall below their break-even price. It will keep tanking like a sinking ship with you hooked to it. And you'll just pray that the market go back to my break-even price. Even sometimes when the market bounces back, it doesn't reach your break-even price. So you're still in the negative. The only way you avoid this is by using a stop loss. But you don't want to use a stop loss, and I'll tell you why. Because you're risking more than what you are comfortable to lose. You can't afford to lose it. You want to make a big profit. So you're not using a stop loss. But a lot of times in an unpredictable market, you plan for something and it doesn't work. No one can predict the market. You just do your technical analysis, you do your research to improve your probability. Your emotions start to get involved if you're not using a stop loss. You don't want to have any emotions when you're trading. You want to make your positions to be completely mechanical with zero emotions. So you must use a stop loss. You have to use a stop loss. Even if the trade goes against your plan, get out. If you're only risking 1% of your balance, trust me, you will not have a problem taking a stop loss and taking a small hit. So use a stop loss. And if you're a beginner, you can choose your stop loss based on many ways. You could use exponential moving average, like the 21, the 50, 100, 150, 200 EMAs. Let's say you're looking at a specific market, you could look back at the previous patterns and see what time frame, 4 hour, 1 hour, daily, weekly, whichever time frame you like to trade on, and see, okay, the market has been respecting the 21 EMA or the 200 EMA, and every time the market goes down to the 200 EMA, it bounces back up. So 200 EMA is my support. So you could have your stop loss a little below the 200 EMA if you're entering, assuming you're entering a long position or you're betting that the market will go higher. Same way if it's reversed. Let's say that 50 EMA is above the price, and every time the price gets to the 50 EMA, the 50 EMA acts as a resistance and it fails to break it. You could enter a short position at the 50 EMA where your stop loss can be a little bit higher than the 50 EMA. Another way you can set your stop loss is Fibonacci 618 zone. The second thing you want to use to risk manage your position is looking at the risk reward ratio of the trade. If you're about to enter a position and let's say you want to take a profit somewhere, it has to be at least 1.5 or 2 to 1 risk reward ratio, preferably 2. The trade has to make sense for you to enter it, and in order for you to take the risk, it has to be at least double or 1.5. Try to aim for 2 to 1 distance away from your entry. So how to apply all of this to find your correct trade position? There's 3 required variables, like I said before: your account risk, your stop loss, and your entry price. And to determine if a trade is worth entering, you use the risk reward ratio in relation to your target price. Before you enter a position, ask yourself, what's my RRR, my risk reward ratio? Is it at least 1.5 or 2 to 1? Once you have these variables, you can determine your position size. So over here, we do an example. Let's say your balance is $5,000 and you want to risk 1.9% of your $5,000. And let's say the market is Luna in the crypto market. And let's say the price or your entry price is at $15.8. You determine that your stop loss price is going to be at $12.71 and your take profit is going to be at $29.11. Okay. Let's say here, this is the Luna market on TradingView. You did your technical analysis. You're on the monthly time frame. This is the weekly time frame. Let's say here you do Fibonacci here to kind of like see where your resistance and support levels should be. You want to measure from here to here. You see here that, okay, at the 618 level and the 0.5, I have my resistance level, and my 1618 extension level is right here. Okay, so let's say you entered a long position above the resistance level, the orange box, or the 618 level. Let's say you decided to enter a long position over here. Okay, so $15.80, and your stop loss is $12.71. Okay, so let's do this here. Long position. Stop loss at $12.71. So $12.71. Below the 618 level. Like right here. At the lower edge of this weekly candle. And your target price is at 29. The extension, the first extension level, 29. 29-ish, and $15 is my entry, and my stop loss is at $12.7 ish. Okay, so you can see here that this is a great position to enter. 4.37 risk reward ratio, 85% target price with 20% stop loss. If I go back to my example here, how to calculate your position. Your risk is your account size times your account risk percentage. So in this case, it's $5,000 times 1.9% equals $95. So this $95 is the amount you're going to lose if your stop loss is triggered. It's not your buying size. You're not buying 95 worth of Luna. Your buying size is going to be a lot more than $95. So just remember, your risk is your account size times your account risk. Okay? The second thing is your stop loss. How to calculate your stop loss. 1 minus your stop loss divided by your entry price times 100 gives you your stop loss percentage. So the stop loss price, which was 12.7, divided by our entry price, 15.8, subtracted from a 1 times 100 to convert it to a percentage, is 19.55, which is almost the same-ish because the decimal of the numbers here are a little different than what I have here. So now we have our stop loss percentage. Now, how do you find your position size? Your position size is your risk divided by your stop loss. So the $95 divided by your 19.55% equals to $485.93. So this is your trading cost or your position size. It's not $95, it's $485. Out of the $5,000 to risk 1.9% at a stop loss of 12.71, you can only, this is your maximum buying size based on your stop loss and account risk. You can only buy 485 worth of Luna to respect your stop loss price and your account size risk. So the numbers of shares that you could buy with $485 is your position size, 485 divided by your entry price, which is 30.7 or 31. So you can only buy 31 shares for the current price of $15 to have the correct position size. If you enter over here, and let's say the price doesn't go according to your plan. Let's say the price goes down to your stop loss price, 12.7. That means that if the price goes to 12.7, you're only going to lose 1.9% of your account, which is $95 as we calculated. Right? But look, is this position worth entering? It is, because the risk reward ratio of your plan is 4.37. I mean, it's more than double. Why wouldn't you enter it? And you're only risking 1.9% or 2%. So even if this one goes bad, even if this trade goes bad, you still have 49 trades to enter. This is how you risk manage your positions. Now, the next thing is how to calculate your risk reward ratio. I know you could get it from TradingView, but let's say you want to put it in a Google spreadsheet. You want to make your own position calculator in a Google spreadsheet. Risk reward ratio is your target price or your take profit minus your entry divided by your entry minus your stop loss price. The target was $29.11 minus 15.8 divided by 15.8 minus the stop loss price, which is 12.71. So we have 4.31 to 1 risk reward ratio, which is the exact same one, close, because the decimals are different here. Now you could calculate your maximum loss that you can lose on this trade is 1.9%, which is $95. Your maximum gain is your take profit home times your number of shares minus your entry times your number of shares. So $29 target price times 31, the number of shares, minus your entry price, 15.8 times the number of shares, equals 412. So you're risking $95 or $100 for $400 profit. Would you enter this position? I would. I definitely would. And if I'm only risking $95 against 400 profit, why wouldn't I? Even if it doesn't go to my target price. Let's say the price goes over here and it starts to reverse. I'm going to get out. Obviously, trail your stop loss. When the price starts to go according to your plan, little by little, don't keep your stop loss over here. You want to move it and trail it according to your plan, or however the market is changing on the low time frames. Okay, but if the price, like, don't come out in a negative. That's what I'm saying. If the price keeps going to your plan, leave it and just trail your stop loss in case the price doesn't go all the way and it reverses. You'll still come out in the positive, maybe 2 to 1 over here, or maybe 1.5 to 1 over here. At the end of the day, you're still coming out in a positive profit. If it doesn't go according to your plan from the entry price and it goes over here, I lost $95. Hey, I got 49 trades to enter. No problem. I can make it up. Okay. Now, if I had I invested more than 2% or more than 1.9%, 5% or 10% of my trade, and I took this loss, it would be more than $95. And I would have less chances or less trades based on my balance. So you want to take 1 to 3% account risk. When you enter the position, you want to see how much risk reward ratio you're getting for that position based on your technical analysis, right? You don't want to be scared of using a stop loss. In fact, I encourage you to use a stop loss. Don't leave any emotions in the trade. Get in and get out. If you don't like using a stop loss, that means you're investing with more than you can afford to lose. And that's rule number 1 in trading. Don't invest more than you can afford to lose. I have another example here. I'm not sure if I should leave it for another video, but I'll quickly go over it. So let's say we have another example of account balance of $5,000 with a risk reward ratio of $2. And the asset price is Zoom Medica with the ticks symbol Zoom. And let's say your entry is at $1.04 and your stop loss is at 1.32. Your take profit is 0.67. So this is a short position. Your take profit is lower than your entry price. Your stop loss is higher than your entry price. So this is a short position. You're betting that the market will go down. So same way, your account size times your account risk percentage. So $5,000 times 2% is $100. So this $100 is the maximum amount you can lose on this trade. Next is your stop loss price. So your stop loss price is your stop price divided by your entry price, subtracted from a 1 times 100. So we see here that we get a negative 27, which makes sense because it's a short trade. So negative 27 stop loss. And your position size is your risk amount divided by your stop loss percentage. So 100 divided by a negative 27 equals negative $370. So the maximum buying power or buying size that you can use for this trade, according to your account risk and your stop loss price, is $370. So to find the number of shares easily, you could $370 divided by 1.04 equals 356 shares for the current price of 1.04 to enter the trade with the correct position size. You can calculate your risk reward ratio by looking at the take profit minus the entry divided by the entry minus the stop loss price. So take profit at 0.67 cents minus 1.04 divided by 1.04 minus your stop loss price. You see here that this risk reward ratio is 1.32 to 1. Is this trade worth entering, in your opinion? I would say no. You can see here from the P&L calculation, it's your account size times your risk per trade. So $5,000 times 2% is $100. But your maximum gain, if it reaches the 0.67, is only $131. So I'm risking $100 for $31 profit. Does that make any sense to you? No, it does not. You could see here on the chart, let's say you on the weekly time frame, and let's say you did your technical analysis, whatever. Let's say here is my entry at 1.04 and my stop loss is at 1.20 and my target price is at 0.68 or 0.67 as we said. And no, that's not what we said. We said the target price is at 0.67, correct? But the stop loss was at 1.32. So 1.32 risk reward ratio 1.3 as we calculated. Entry price is at 1.04. Target price is at 0.67. Does this look like a good position? No, it doesn't. 1.3 risk reward ratio is not worth it. And I did my technical analysis over here. We hit a resistance before. So I'm kind of like, okay, maybe if we reach this target price again, or we reach this resistance level again, maybe it's going to drop. I'm going to short it. And my stop loss ideally would be here where I had it before. And in this case, the risk reward ratio would be 2.19, which is better than 1.3. So it all depends on your technical analysis. It all depends on your plan. But you want to have 1 to 3% risk reward ratio. You want to use a stop loss. You want to check your RRR, make sure it makes sense for you to enter. And then you can calculate your position size. I would recommend you to use something like a Google spreadsheet. Plug in all these formulas in the Google spreadsheet and make your trades as mechanical as possible by testing the RRR in the spreadsheet, see if it's worth entering. And this spreadsheet can also be your trading diary. You want to have a trade diary, a trade journal in your trading. It helps you see how you're doing. It helps you see your performance. For example, I could show you a snippet of my spreadsheet. So this is a snippet of my spreadsheet here. I have account balance over here. I have my entry price. I have my take profit price. I have my stop loss price. I have my stop loss percentage, my account risk, the numbers of shares, my risk reward, and my maximum loss, my maximum gain, and how much the trade cost, and my actual exit price. And based on my actual exit price, I'm going to calculate my closed position PL. And I get my account changed, whatever. I put some notes in there. What was I thinking? What was I feeling? And my discipline rating. And based on this, the account balance changes. So my closed position PL is basically a sum of all of my closed position column plus my starting balance gives you your final balance. Does that make sense? So if you have any questions, leave it down in the comments below. You could easily build a spreadsheet by using the formulas that I have gave you guys in the previous slides. Over here, I have a complete all the markets in Binance. I have whether I'm going long or short, the time, the date. These are all good parameters to have when you're entering a position. I could show you an example. Let's say the balance is $5,000. The entry price 15. Let's do the long position example. 15.8. Just so you can see how it works. My take profit was 29. Okay. My stop loss was 12.71. So it automatically calculates my stop loss percentage. The gray columns are the inputs. The white columns are the outputs. So I'll put my 1.9 account risk. It calculated the amount of shares that I can buy It calculated my risk reward ratio. It calculated my maximum loss. It calculated my maximum gain. It calculated my trade cost. And once I put in my exit price, let's say I was aiming for 29, but if I put 29, I made the maximum gain $405 or 8.12% account change, and it will add it over here and it will change it. Let's say I exit the market at $20. Okay, I just took my money at $20 and the price reversed at $20, right? So it will tell you, okay, my close position was 129, a lot more, less than 4.27 risk reward ratio, but nonetheless, it's 2.58% higher than where I was before. And it shows here in my account balance. So it's important to have a spreadsheet. I gave you all the formulas. You could easily plug it into a spreadsheet and build your own. And you want to have a good risk management policy or rules for yourself. And with this, I'm going to end it with these professional traders quotes. And if you have any questions, just drop it down in the comments below. I know this video was too long. I didn't mean to make it too long. I wanted to share everything. So if you have any questions, feel free to leave it down in the comments. And if you have any suggestions or if you need help with anything, please let me know. And I'll see you guys in the next video. Peace.